feel that there are two aspects. One is a fundamental reason, the other is a technical reason because of which small hike in reverse repo makes sense. The fundamental reason is that uh, during the pandemic, there were two emergency measures that were taken. One is that the operative rate was moved to reverse repo. The second is that the repo reverse repo corridor was widened. We believe that the activity variables are telling us that there is no emergency anymore. And the big risk of a third wave being quite devastating, that risk is also lower now, given the vaccine penetration, etc. So if the emergency does not exist, then possibly these two measures needs to be slowly retracted back. And the technical reason is that if RBI has to do 4, 5, 6 trillion rupees of variable rate reverse repo auctions even going forward, then if you have a corridor as wide as 65 basis points, then there is every chance in the successive auctions, the cutoffs come in at very different levels, making the short end of the curve extremely volatile, which is not desirable from a monetary policy perspective. So because of this fundamental reason of reverse repo cut being an emergency measure and the technical reason of a very volatile short end of the curve, we think now it's time to narrow down the corridor and get rid of both these issues. But at the same time, we are arguing that from a cyclical/structural perspective, interest rates still need to be at a very low level for a long period of time. Hopefully, if RBI starts early on taking out the emergency measures, then they have a scope to have a lower for longer repo rate stuck at 4%, along with substantial amount of liquidity in the system.
Samir, I'm going to sort of take parts of that and delve a bit deeper. So, the RBI, yes, cut the reverse repo in an emergency move, widened the corridor. That has now become the effective rate hike. So, hypothetically, if the RBI were to hike the reverse repo rate, would they need to make a distinction between this not being a signal for interest rate hikes and this being a signal for removing emergency accommodation? It's going to take a lot of deft communication, because already you've started to see when those variable reverse repo cutoffs came a bit higher, even the long end started to react, right, in anticipation of this being normalization. So how do you think the central bank can balance the need to not tighten financial conditions this early in the cycle, but start normalizing some of the emergency accommodation?
Absolutely, the communication is going to be challenging for sure. In fact, we have written it in our report as well, that that this distinction that I'm making between emergency measure versus the so-called cyclical/structural measures, that distinction often might not be very clear for the markets. But having said that, since the RBI has allowed the VRR cutoff to go as high as 399 in the latest one, the market has practically priced in this 15 basis point reverse repo high. Now, the question is that you can defer it by another policy and do it in December, but that's not going to achieve a lot. The bigger question is what you were saying about how to ensure that this does not transmit into the long end of the curve.
Yes.
I think the short end is still okay for RBI, even if it is reprices 15, 25 basis point, that's probably just fine. And there, I guess the good news for RBI is that the second half borrowing calendar has come out to be a very benign one. So despite our assumption that RBI will probably lower their announcement of the GSAP purchases, they will have still enough wiggle room to manage the long end just in case the long end starts moving up beyond what their comfort level is. They've found a way of combining the GSAP with Operation Twist.
Yeah.
And that's how you can ensure that you keep the long end absolutely rock solid at a level where you want it to be. I mean, one can argue whether this should be at 6%, 6 quarter, or 650, that's the central bank's choice. But at least the levers that RBI has to control the long end is now more flexible at this moment. Having said that, we have to also understand that there is another issue of bond index inclusion at some point of time that will come and play a role in the long end. So even that can provide some flexibility to the central bank. So I'm not so worried about their signals getting transmitted immediately into the long end and disrupting the market.